welcome. Thank you very much for having me here today. So, global equities, obviously we're at a pretty interesting point in markets. We've had a massive, the markets have been incredibly strong. The AI boom's been incredible. But I thought what I wanted to do today was just try to give a bit more perspective across other areas of the market. You've all probably heard 1,000 presentations on the wonders of the Mag 7, but there are other opportunities. And I think we're at a point in the market now where I think as advisors, consultants, you need to start thinking about where you can diversify, the changes that you can start to potentially make to client portfolios. So the things I wanted to really drill down on today was, a lot of the questions you would have. Will the Mag 7 continue to drive markets for the next 5 years? Are there some areas that you should start to rethink? Are there some changes you can potentially make to portfolios? I want to drill down also just on some of the style volatility we've seen, which has been massive, particularly in the last 12 to 18 months. And then where you can find different opportunity sets. And the opportunity sets are quite different. I just encourage you to try and broaden your horizons a little bit, because there are other areas of the global equity space that they're actually doing very well, but they're completely ignored. And then lastly, I'll come back to sort of the global small mid-cap opportunity, which is an area of the market that we have a big role in. And I think that should be a much bigger part of portfolios. So just thinking about, I'll touch on the Mag 7 quickly. And again, this isn't a beat up on the Mag 7. We've got exposure to it. But we are at a pretty interesting point in the market where they are at a point now where growth has obviously been exceptional, as we know, but it is slowing. And that's something that I think everyone's just got to pay a little bit of attention to. If we think about sort of those 7 names, the earnings growth into next year, 4 of those 7 names, the earnings growth is going to be sub 15%. So that is quite a bit lower than what it has been in the past. Yet valuations are very, very high. So that's always a bit of a canary in the coal mine for growth stocks, is when growth slows and multiples are at their highs. And we obviously saw in the DeepSeek sell-off a couple of months ago is that when the market catches a cold, these things can come back, very, very sharply. And again, I'm not trying to beat up on Mag 7, but the risks there now are much higher than what they were 6 months ago. And so I just think that's something we've got to think about. Obviously, the contribution, the index contribution of the Mag 7 has been massive. So over 5 years, 7 names have accounted for 30% of the returns. 30%. It is quite extraordinary. I don't think we've ever seen that, even back in the dot-com boom and bust. So just some things to sort of think about. Again, I just want to flag some ideas and some changes that you can potentially think about with global equity portfolios. Active management's been terrible for the last couple of years, as you all know. But I think that has sort of got completely out of whack. Quality as a style has obviously been pretty poor more recently, but again, that's got out of whack. Try to position portfolios for more market breadth. We are seeing more market breadth in markets this year, but I think that's got a long way to run out. Reducing exposure to Australian equities. I manage Australian equities also, and it's very, very difficult, frankly. And look for other areas like Europe, Japan, what I call the S&P 493, the other 493 stocks in the S&P 500. There's some really good companies there that have done really well, but they don't have enough representation in portfolios. And last but not least, come back to small mid caps. And again, anyone who says this time it's different, put your fingers in your ears, ignore what they say, because that's never true. So first of all, and apologies if this is going to come across as death by 1,000 charts, but what I want to point out here, so this is looking at the MSCI World. The chart on the left shows the MSCI World Index performance over the last 10 years. And so the white line is just the performance of the index. Is it up there? Next one. There we go. So on the left there, so that's the MSCI World Index. The blue is earnings. The red is valuation expansion. So the returns are some combination of that. And obviously for 10 years, the earnings have done a lot of the heavy lifting, and a lot of that can be attributed to the Mag 7, which you all know. On the right-hand side, this is where it gets a little bit scary, because the last 2 years, more of the performance is coming from just valuation expansion. So this is a bit more fear of missing out. The same thing did happen in '99. where, the growth is slowing, but the multiples continue to expand. And so that's just sort of something that, again, it's not trying to scare you, but we are getting a little bit later in the cycle. And again, that's a risk I think we've got to be more aware of. Looking at the, again, this is looking at, I'm just scared to walk past that mic now. This is more getting into active management. And so this looks at the percentage of strategies that have outperformed over certain time periods. So in the middle there, you can look at, so these are global large cap strategies. And again, I think you already know this, but if you look in the last 5 years, you've only had 30% of global equity strategies have outperformed in the last 5 years. A lot of that is due to the Mag 7 or lack of exposure or lack of management. But in the small mid-cap space, that hasn't happened. The actual percentage of managers still outperforming has been very, very high. So again, if you think about where you want to allocate your active strategies, having more in SMID does make sense. But I also do think that the large cap allocation, that's poised to rebound quite a bit. And that always does happen. When the Mag 7 does come back, you see more and more strategies outperforming. So again, active management it's bruised, but it's not dead. And then this is my least favorite chart as a quality manager. So you've seen some pretty wild performance in factors in the last 12 months and the last 18 months. On the right-hand side, that yellow bar, that's the Goldman Sachs non-profitable tech index. So if you completely ignore fundamentals and valuations, you've absolutely nailed it. On a year-to-date basis, that chart is actually up about 58%. This does remind me a lot of 99, 2000. I was working in San Francisco for a fund manager in 99, 2000. I saw this, and again, this starts to get pretty late cycle. And then you've also seen other areas of the market like, the cyclical stocks that rallied in advance of, interest rate cuts, what that's going to do for growth. And then, the growth area of the market, again, more recently, that's been more multiple expansion. The growth has been good, but it's becoming a lesser part of the returns. And then quality's lagged. The fundamentals are fine. You're actually still seeing earnings upgrades, but it's the only area of the market where you've seen multiple compression. So I think the point I'm trying to make is that it's a good opportunity time to allocate back to quality because the fundamentals aren't necessarily sort of suffering. Again, this tells a similar message through the prism of the small mid-cap universe. So you've seen what I call the junkier ends of the market. So whether it's bank or cyclicals, they've done incredibly well. A lot of them in Europe have done incredibly well. But again, the stocks have probably run ahead of earnings. Again, it's a lot of multiple expansion and sort of speculative investments that have run those sectors up. This is a bit scary, this one. So this is looking at quality within the prism of the S&P 500 index. And what it shows is that, right now, quality stocks are at a point. Now, the last time that underperformed by this much was literally 99. Was about 3 months before the dot-com boom and bust sort of imploded. But it also highlights the fact that if you're brave enough to lean in on quality, when it has lagged, it can rebound extremely strongly. And again, if you did that back then, you would have generated about a 30% return in the subsequent sort of 18 months just by leaning in opportunistically buying quality. So that's a little bit sort of on style. When I think of Australian equities, I just think hard work. This is an area of the market that I think you need to think about if you haven't done so already. Try to reallocate away from potentially Australian equities. Again, I've been investing in them in addition to global since 1997. And I've never found it harder, frankly, to find good things to invest in. As we all know, the opportunity set is somewhat limited. The massive size of the super system has made it difficult to, that's inflated multiples. So that's made good quality Aussie stocks look extremely expensive versus their global peers, which is not great. And if you think about what I've called the yesterday's heroes, the great companies that have generated great returns over 10 years, they're not necessarily doing what they did in the past. And there's not a lot of companies that are taking their place. And if they are, they're very, very expensive. And some of the better companies, whether it's, CBA trading on a massive premium to JP Morgan just doesn't make any sense. CBA is a good bank, but it's not that good. Wesfarmers is, last time I looked, was 34 times earnings. The multiple is almost double that of Home Depot. So it is tough. Like, I find the Australian market very, very difficult at the moment. So again, I think you tend to look for opportunities to allocate away from Aussie. When it comes to dividends, there are actually other areas of global equities where there's good dividend growth, and I'll get to that. A couple of them. So if we think about Japanese equities, so for my sins, I've been looking at Japanese equities for about 30 years too, and that's a pretty long waiting for them to work. But they are finally starting to work quite well. And what you've actually seen is that the performance in Japanese equities have been really good, and the earnings growth has actually been staggeringly good. And the chart on the left-hand side there shows that the returns have mainly been driven by earnings growth. So that the blue part of that chart on the left is showing that, again, earnings growth has been exceptional. And what's happening in Japan is that a lot of, like, the government, the stock exchanges, the regulators are encouraging companies to improve their corporate governance. So they're buying back shares, they're paying special dividends, they're improving their return on equity, and all that is driving what's actually really, really good performance. So Japanese equities are, really interesting area of the market. I was looking at this morning, but the earnings growth from 21 until this year has been about 36% versus MSCI World of about 25%. So Japanese equities have actually outgrown the global market, notwithstanding the incredible performance of the Mag 7. But again, it's not like most global investors are very underweight in this area of the market. And in a way, I think about this as being like an area of like defensive earnings growth. It's not all coming from top line, from like revenue growth. A lot of it's just coming from basically companies improving their balance sheets. And if you look at the size of the size of the share buybacks, that chart in the middle, so that's equivalent to, I think it was $130 billion of share buybacks announced this year, which is equivalent to 3% of the Japanese equity market. I mean, that's a remarkable underpinning. And again, to my point earlier, the dividend growth has been really good too. So again, that's an area of the market that's we think is really interesting and not really appreciated that much. And they're not that expensive too. They trade on, it's about 15 times earnings, Japanese equities. US equities trading on about 22. So again, they're not that expensive. You don't have that same valuation risk that you've got in other areas of the market. European equities, so as Anthony would tell you, like when I was presenting probably early last year and I was talking about being overweight European equities, I'd have to put up the chicken wire because they were incredibly out of favour. They'd lagged terribly, but they were some of them were very inexpensive. And it was more on the basis we could find really good companies in Europe that were just completely, they were just very undervalued. And more recently, you've actually seen this phenomenal recovery in European equities. And there are some very good companies there. And again, the chart on the right is showing you that it's mostly earnings doing the work. It's not valuation expansion. It's earnings are really driving the markets. So again, it's an area where I think people, when they think about global equities, they have a hard time moving away from the Mag 7, but there are lots of opportunities. Again, like Japanese equities, they're cheap. They trade on about 15 times earnings. From what we've seen, the earnings growth is probably looking like about 10% annually for the next 2 years. There's probably a bit more upside to that. So again, it's an area of the market we think is pretty good. I mean, the chart in the middle, all that shows is that, again, it's just that the valuation's not doing the heavy lifting. The valuations have expanded a bit off extreme lows, but there's still room to move. So this is what I call the S&P 493. So this is every other stock in the US, S&P 500 that doesn't get talked about, but has actually delivered really well. There are some fantastic companies there that I think people need to think about getting more exposure to. They account for about 65% of the US equity market. They trade on collectively they trade on about 10p point discount to the Mag 7. So much less valuation risk. And 64 of those names have actually outperformed the Mag 7 over the last 5 years. So there is a lot of, there's a lot more breadth within the US equity market than I think people realise. And some of those names we've had exposure to. They're not all tech stocks. Boot Barn, sells boots in Texas. You've got some pretty weird companies there, but they've done pretty well. Dick's Sporting Goods has been that's been a phenomenal sort of retail story. Oracle, we've had exposure to things like Arista and Oracle, so Broadcom. So there's definitely some tech exposure there, but it's not all tech. And then on the right-hand side, you can see that there's a lot of companies that are just incredibly consistent. So we all know Costco, TJX in the retail space. Rollins is the most boring company you could think of. So they're in like pest control. So a colleague and I went and met with them about 8 years ago in their office in Atlanta. It's very boring, but it's very consistent. And they generate about a 25% return on capital. So again, it's a great business in a boring industry, but it compounds incredibly well. Zoetis is the old healthcare business that was spun out of Pfizer. It's much better treating animals than people, far less regulatory risk. And so there's some terrific businesses in there that, again, can play a really important role in portfolios that I think you should just think about ways you can get more exposure to. So that's the S&P 493. And then getting to, so those are a couple of like geographical pockets of opportunity, just to sort of think about. Now, I want to sort of pivot to like another one, which is the global small mid caps. So global small mid caps, just to put it into context. So this is the MSCI defined as the bottom 28% of any market. So it's ballpark the bottom third of global equities. And again, most portfolios have got very little exposure, but it's an asset class that has actually, over a very long period of time, it's done very well. It gives, and the way to think about this is, I often get asked, how does this fit? How does it fit in the portfolio? So first of all, it plays a growth role. It can complement, so, like large cap growth, emerging markets, Aussie small caps. So, and the way I'd contextualize that is there's less valuation risk than large cap growth. There's less absolute risk than emerging markets, which is a low bar to jump over, but that's true. And I think a better opportunity set than Aussie small caps. Aussie small caps are hard work to find really good quality, to be honest. And they should continue to sort of grow. They've grown earnings actually really well, notwithstanding the fact they have lagged a little bit more recently. And then I think the other point being is that donut chart there just sort of shows that it gives you really good geographical and sector diversification. And I think that's important. So the growth is coming from industrials, it's coming from financials, it's coming from the consumer sector. So it's not just tech. So it does tend to complement a large cap global portfolio really well. Again, over 25 years, it's been a really, really good performer. And that shows that in the last couple of years, it hasn't outperformed, but the earnings have. So the earnings growth has actually been better than most other areas of the market, but they've not had the benefit of the PE expansion that comes with that with passive investing. But the stocks have done very, very well. It's been a great asset class over 25 years. So, and again, so sort of thinking about sort of the growth factor, because that is the role that it plays a growth role in portfolios. The charts on the bottom just show that from a historical and a forward-looking basis, the asset class, it has outgrown on an earnings level and a sales level, and it should continue to do so going forward. That chart on the top left, I just sort of, like if you think about where a lot of portfolios are placed on that curve, as Mag 7 exposure becomes a bigger part of portfolios, basically more of your portfolio is moving towards the pointy end of that red arrow. In other words, you've got more exposure to companies where growth is starting to roll over. That can be quite dangerous because that's when you get more in the vicinity of multiple expansion. So making an allocation to small mid caps is more about allocating to those companies that are they're past the startup phase, but they're earlier on in their growth trajectory. And that's really the role that it plays. And that's frankly where you make the most money, when growth accelerates. And that's the role that sort of smalls and mids, can play in portfolios. They're cheap. They're cheap. They're just not nearly as expensive as just about anything else you'd look at. And interestingly, I was looking at something the other day that looking at the earnings growth of small mid cap stocks versus large cap peers from the basically from the COVID lows. And small mid-cap stocks outgrew their earnings, outgrew large cap stocks by about 15% from the lows. And so what they did, they actually cut a ton of costs and they took a lot of debt off their balance sheets during that COVID period. So they've actually outgrown earnings, but they've underperformed because they haven't had the multiple expansion. So again, and that's obviously relevant because market valuations are very expensive. They've picked up a lot. So again, you're mitigating risk, valuation risk, by making an allocation there. The catalyst, I always get asked, what's the catalyst? The catalyst comes down to a couple of things. So it is the fact that looking into next year, earnings growth, again, will be better than the large cap peers, and it's starting to accelerate. US small mid caps, you'll start to see some effects like demand start to come back as a result of interest rates being cut. The consumer in the US, and obviously we've had tariffs. There's been a lot of, I call it White House noise, that's kept a lid on the economy per se. But I think that will start to mitigate and sort of start to trail off into next year. So there's a good argument that as the earnings start to inflect, that will be the catalyst for the asset class to start to work really well. Here's an example of just some of the companies we own. I mean, I call them the best companies you've never heard of. But collectively, I mean, they are very profitable. And I think this is another thing where a lot of people, when they think about small mid-cap stocks, they think about companies that are much earlier on in their growth trajectory. They're still burning through cash, raising capital. That's not necessarily the case. There are some fantastic companies in there that are past that adolescent period, but they're generating, I mean, these companies collectively generate a return on capital of 26%. They've got no debt, and they've grown earnings at 16% a year for the last 5 years. And they traded on a free cash flow yield of 4%. So they're not incredibly expensive. And then from a size perspective, the average market cap's about 25 billion. So they're not tiny. So global small mid caps, they are much bigger than what we find here in Australia. So you don't have that liquidity risk that you would find with small caps in Oz. And then when I think about sort of like these are some of the names that we've owned that have done well over a long period of time. And again, it's a broad array. It's not just US tech companies. It's companies in healthcare, financials. Again, a lot of European companies more recently. Surprised some, but we've had things like the Hong Kong exchanges, which has been a phenomenal performer recently. Euronext, Deutsche Börse. So again, you're getting performance from areas outside the Mag 7 that are a bit more. They're not as correlated, and I think that's really important. So it's an interesting opportunity set, and again, I think it's something that I mean, more and more investors are starting to lean into, but I think it needs to be a bigger allocation in a lot of portfolios, and now's the time to really do it. So again, sort of just thinking about some of the catalysts, there is a lot there. I think thinking about some of these now, easing geopolitical tension. I mean, that might be wishful thinking, but it will happen one day. And the tariff uncertainty has obviously gone on for a lot longer than what we thought. But actually, just on that, I think another point I didn't mention was that if we think about CapEx spending in the US, a lot of that has been delayed in probably the 3-month period before the election, but that does need to start to come back to life next year. So I think that's another important catalyst. And in many ways, a lot of the US small mid caps are beneficiaries of tariffs because they're being protected from peers offshore. So there are some actual beneficiaries. And I looked at it, there was a stat that showed that I think it was the Russell 2000, the average domestic revenue was about 85%. So they're quite domestic US companies. They don't have the same tariff risk that Apple or other companies would typically have. M&A activity is starting to finally come back to life. And again, I think there's a lot of catalysts there. So to sort of summarize, I think the main message I'm trying to get across is I think now is a time when you should start to think about changes you can make to allocations. There's a lot of opportunities just outside the Mag 7, and Mag 7's been great. We've got exposure to it, but it's not the only thing to have exposure to. And I'll just encourage you to sort of broaden your horizons a little. So with that, I'll come up for air. I think I'm going to take some questions.
Thanks, Ned. Insightful. A quick question with the next 493. A lot of the issues you talked a lot about US and other opportunities, but in the US, of course, you've seen, tariffs change, and a lot of these companies, how exposed are they to importing goods or services to deliver to their clients? And therefore, what's the potential impact of these newer tariffs in the US marketplace?
Yeah, it's a really good question. I mean, the short answer is I think they've all got, I mean, a lot of them have got exposure. So if you think about, Nike, for example, anyone in the textiles industry, that's definitely an exposure. However, a lot of those companies since COVID have diversified their manufacturing bases outside of China to Vietnam and other countries. So it's less of a risk than what it was. And I think the other thing is that, so when you think about how do you get out of the crosshairs of Mr. Trump, you turn up to the White House and you promise to build a big plant in Alabama that will, and I'll start doing it in 4 years' time when he's gone. So I think a lot of the companies have sort of, the playbook is becoming a little bit better understood. And I think the other point I'd make is that I think the question is like, when are they feeling the maximum earnings pain? And it's really this year. This year is when they're feeling the pain. I think going into next year, that's when you start to get a bit more of the recovery. I mean, I think the reality is that, and Trump had a pissy fit the other day and threatened another 100% tariff on China and then reversed it within about 30 minutes. So I think he realizes that the actual economic effects of these tariffs is a lot more significant than what he had acknowledged some time ago. So I think we're past the worst in a nutshell. Sure.
Yeah, Rob. The valuation charts that you put up about SMID versus the global markets were really interesting.
Yep.
I'm wondering how that might look when you take out the Mag 7 and the equivalent of those kind of stocks in Europe and Asia.
Yep.
Does the SMID become a proxy for just the ex-Mag stocks, or is it still cheaper relative to those?
In a way it does, yeah. So if you look at the valuations, for the valuation differential between, say, the equally weighted MSCI index and the SMIDs, it's not that different. However, you have seen, but SMIDs are still cheaper and the gap has opened up, and that's partially because in the last 12 months, you've had a lot of large cap European banks, for example, US banks have actually done very well. So the equally weighted index multiple has actually expanded a little more. And I mean, frankly, so it comes back to why has the multiple expanded so much? A lot of it is to do with passive investing. What we saw when we saw the DeepSeek sell-off, the Mag 7 all dropped within about 0.5% of each other over 2 or 3 days. And that's just telling you it's passive selling. So I think the valuation gap is still really, really compelling, if you like, but it all comes down to the catalyst, right?
Yeah. Thanks.
Sure.
Ned, what's the role of thematics like artificial intelligence in your stock selection process?
Yep, it's a really good question. I think thematics for us tend to, so again, we're a quality manager. We screen for companies with great profitability and growth and balance sheet strength. The thematics have a way of emerging through the process. What we don't like to do is say, like, we've got a thematic on AI and therefore we're going to find the best fit. I mean, that's a great way to get into trouble, frankly. But the likes of Nvidia, Broadcom, I mean, 6 of the Mag 7 screen extremely well for us. So our process takes us there anyway. But it also steers us away from, like, there's peripheral AI themes, for example. So so whether it's in private credit or whether it's in, there's a lot of those companies in the US that are like the HVAC air conditioning companies that are putting air conditioners on data centers. I mean, that's really stretching it. I mean, our process will probably steer us away from those. So I think you've got to be really aware of the thematics, but you've also got to be aware of the crowding effect in those names. I mean, like the AI theme is like, you can't be so skeptical that you're not going to invest in them, but you have to understand how these things are owned. And the DeepSeek sell-off was the lesson in that. So if you look at the register of whether it's Nvidia or Broadcom, and you know, we own these names, but the percentage of ownership from growth managers and also from, you know, mum and dad investors has exploded. So you've got to be very cognizant of that. It's not about being a non-believer in AI. It's just recognizing that the enthusiasm around some of the thematics, it has to happen when it turns, the multiples tend to drop pretty quickly. But I think and it's not just an AI conversation, but it's also, I think, again, I mean, our process sort of tends to steer us in a certain direction. So, for example, now, if you think about like I had them up at some of the highest quality low beta stocks in the world, like whether that's Costco or, I mean, Procter & Gamble is considered incredibly boring, but it is a very low beta stock. And a lot of those names are very, very inexpensive, like very inexpensive. And again, coming back to 99, when the dot-com boom busted, like everything that worked, it was healthcare, it was Staples, it was Costco, it was all those sorts of companies. So again, our process tends to steer us in that direction, as it does with Japan. So Japan I mean, I consider that to be a thematic. We've got more Japanese companies that passed our initial filters now than has been the case in 25 years. Like in 25 years, like that is quite amazing. I mean, I'd say 5 years ago, there was probably only a dozen Japanese companies who would screen. Now there's about 60. And again, it's this improvement in return on equity that's really driving. So the themes are, we don't like crowded themes. We like themes that are not picked over. And often when just any Americans in the audience, but like when I go to the Japanese conferences, if there's no Americans there, I'm like thrilled. I'm like, I know I'm not too late. Sorry.
One American in the room.
Does currency have to be factored into some of the investments that are going overseas? Because you're talking about mostly overseas, the US and Japanese and Europe.
Yeah.
So currency has, in the last little while, been a factor from an investment point of view. So
Absolutely.
is it longer too?
Currency is always an important factor, I think, with global investing. And I think for anyone who's prepared to put their foot into global investing, they have to accept that as a risk. But what I would say is that in many cases, there's a natural currency hedge. So if you're investing in Apple, for example, you're buying US dollars to buy Apple, but they're selling, you know, more than 50% of what they're selling is outside of the US. So there is a natural currency hedge, but it's delayed. But then when it comes to things like Japan, you've got to be very cognizant, but you can be very opportunistic too. In that, for example, we've just started a position in Recruit, which is the owner of Indeed. So the yen's obviously, you know, been very, very weak. So we've had the opportunity to opportunistically buy cheap yen at the time when Indeed was also out of favour. The currency hedge is a bit less prevalent in small mid caps because they're more domestic UK, domestic US, domestic Japan. But you've got to be very conscious of it, obviously.